So what is one of the underrated fundamentals that you need to start getting high limit credit cards from the start and credit limit increases? What is one of the financial metrics that you need to master in order to put yourself in the best position? And it can potentially overpower not so great credit. I'm going to explain that to you in this video. This is JP from Blueprint for Prosperity. To all my pioneers, welcome back. To all my new viewers, welcome in. I want you guys to like and comment, subscribe. We're going to get right into the content. So when you're dealing with credit cards, you have to understand something, because there's a little confusion out there in the space about what type of relationship banking or metrics that you need to have that are most useful. Something that's a little confusing that I think will help you guys in your journey to establish, great credit relationships with these, bigger and smaller issuers and get access to high limit credit funding so you can expand your finances, launch businesses, jump into investing, leveraging your credit to do so, is the misconception that having a bunch of money on deposit with these banks is the golden ticket to those higher limits. It's wonderful. It's a great value add. I'm sure these institutions price that in. But believe it or not, what many aren't understanding is there's another financial metric that kind of gets skimmed over that's a bit more powerful. I'm going to make it make a little bit more sense for you. See, when you have a goose egg or a lump sum of money with an institution, it's great. That money's in there, and every day it's in there, they're able to take that money and, show it to the Federal Reserve, whatever the case may be, and fractional reserve lending kicks in, and they're able to, lend out, get their access to, and lend out multiples of what you put on deposit, as well as other ways they make money on your deposits. So it's wonderful. But at the end of the day, in most cases, it's still one lump sum of money. And it's some peace of mind. But it's not quite the same peace of mind as if you having a significant cash flow difference on your income or your DTI. And that's because your credit card bill or any other debts are going to be monthly debts. They would love to see, even if you don't have money on deposit with them, they're going to love to see that you have a tremendous spread between your gross or total income or stated income versus your monthly expenses reported on your credit report. Honestly, that can be one of the golden gooses. And I'm telling you from experience, I'm not talking just from conversation or, internet forums. I'm telling you from personal financial experience. And I'm telling you as a banker, helping clients do applications for credit cards from all financial ends of the spectrum. People who are walking in are just working class and very wealthy and successful individuals. I've helped the top to bottom. I've helped them all get credit cards, with different banks that I've worked at, a couple of, small institution and a larger institution. These financial institutions find a substantial excess income, excess cash flow very attractive. And even if you don't have much money on deposit with them, and I mean, seriously, you might only have a few hundred or a couple $1,000s on deposit with them, and you can apply. If you have a healthy credit profile, healthy credit score, and you combine that with a sizable DTI or excess cash flow. When I mean sizable DTI, I mean gap from your monthly expenses reported on your credit report, including your housing costs and what your gross or stated income is. Banks love this and they reward it handsomely. What ends up happening is people are able to get 50, 60, 70, sometimes 100+% of their income in credit limits. And I mean, like if you make $70,000 a year, you can get a credit limit for 35. That's 50% of your income in one credit limit, which is outstanding. That's amazing. You're able to do that. And these banks are willing to do that with you if you have the gross excess income. Because again, it's really about payment when it comes to debt. When you think about it, it's really like payment. It's the same thing with buying a house. The house can have whatever sticker shock purchase price or sticker price it wants. But if you break the payments out over 100 years, it doesn't matter because now the payments are like this, right? You can get $1 million house and you may look like there's no way I can afford $1 million house. But then some lender comes out with a 50-year loan and those payments are the equivalent of a $300,000 house on a 30-year loan. it doesn't matter it's $1 million house. You see what I'm saying? It's the same kind of concept when it comes to credit cards. Now, obviously, credit cards are intended to be paid in full every month. That's the most attractive thing. Or paid down to very low minimums. That's the most attractive things to these lenders because it keeps them from being at risk of you leaving balances on the card and potentially defaulting, whatever the case may be. But that having been said, you're still getting it's a monthly credit limit. So you're paying down, and if they're looking to see a great DTI, a great income, that's gonna allow them to say, okay, this person has, $2,000, $3,000, $4,000, $5,000 a month excess income from their monthly expenses. So we can afford to give them magnitudes on that limit because from what we can gauge, that person can afford, they're gonna do so much spending on a card. So, at the end of the day, they're weighing these algorithms and calculations out, probably guesstimating what your spend is gonna be based on your income and your other financials and other data they have, and saying, this person, we can afford these limits with this person, or it's a lower risk to give this person a higher limit and more profitable for us because we're giving them more room to spend. And what we can see is from their stated or verified income is that they have the cash flow on a monthly basis to make up for it. That lump sum of money can go in and out at any time. It's that one chunk of money. It's good. It's accounted for. But my bet is that somebody who has $25,000 in the bank on deposit, but only has $500 a month cash flow from their expenses to their gross or stated income, versus somebody who might have $2,500 in the bank account, but has $3,000 a month and a gap on their DTI from their monthly expenses to their gross annual income on a monthly basis. Is the person with that larger cash flow on a monthly basis is going to outscore that person on their credit limit. My guess, 9 out of 10 times, if everything else is the same. All else variables are the same, but this person has a larger gap in monthly cash flow, and this person has a one-time lump sum in that account. This person, in my opinion, the person with the higher monthly cash flow is going to beat them out on that credit limit. So that's a trick for you guys because honestly, extra, overtime, tips and commission. Remember, credit cards are stated income. As long as you can verify it, and you're filing on your taxes or you have check stubs to back it up, whatever the case may be. As long as you can back it up if they ask, then at the end of the day, you don't have to, have that income a certain amount of time and things of that nature. You got overtime, you got tips, commission, whatever the case you have to control inflating your income on a monthly basis. That gives you more control to get yourself access to these higher limits. I know this was valuable content to you. I enjoyed bringing it to you. I want you to comment down below. Let me know what your experience has been. Can you verify any of these data points that I'm putting out? Do you have great cash flow on a monthly basis and have you seen higher limits? Or what's your experience been if you have a lump sum of money on deposit and what your credit limits have looked like in that scenario? Let's talk about it in the comments down below. To all my pioneers out there, I appreciate y'all tuning in. If you want to support the channel, links are in the description to some great credit cards and credit builder loan options. They are great referral links that'll either put extra cash in or get you a great welcome bonus and support the channel at the same time. A pure win-win. So you can keep supporting the channel and the channel can keep supporting you. Other than that, I appreciate y'all tuning in. I want all my pioneers to stay focused, stay in motion. I'll see y'all soon.
This is JP from Blueprint for Prosperity Network, a channel dedicated to helping you increase your net worth through relationship banking, maximizing your borrowing capacity, the proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity.